This is Robert Kraft, and I am your host on SNN.Network. And with me today for this Wall Street Review is Paul Andreola from Smallcap Discoveries. Paul, welcome back. It's good to see you.
Yeah, it's great to see you too, Bobby. Good to be here.
Great to have you as always. So, for those who may have missed any one of our interviews that we've done, whether it's for the podcast or the magazine, let's start with your background, and how you ended up to where you're currently at today.
Sure. So background is I've got a very sort of career start. I studied in construction management years and years ago, but I really had a passion for investing, became a broker and investment banker, and then finally got out of that side of the business and became a full-time investor probably about 10 years ago. A little while ago, I teamed up with Brandon Mackey and started a newsletter, Smallcap Discoveries. That was about 5 years ago. And just our love for investing in microcaps has sort of brought us to where we are right now. And we're constantly trying to find great little Canadian, publicly listed microcap stories.
That's for sure, and we've definitely seen that over the years. And we always appreciate you and Brandon coming on and sharing your insights on what's going on in the Canadian microcap space and really microcaps in general. But the main reason that I brought you on today is that on Smallcap Discoveries, you guys just recently published an article titled "The Art of the Rollup: 7 Keys to Success." So to start, for those who may not be aware, what exactly is this rollup strategy?
So rollup is, some might call it M&A or mergers and acquisitions, but rollups are really a company that tries to establish a business within an industry by, buying up other companies and aggregating a larger entity where they can, increase their pricing power or, synergize sales strategies, things like that. It's a strategy that's relatively well known. And we think it works particularly well within certain industries and categories of companies. But it is a growth strategy apart from just organic growth.
So in this article, you talk about how there is these 7 keys for success. So now we're going to dig in here. What are those 7 keys?
So, over time, we've seen a lot of efforts in sort of the roll-up strategy. And what we see there's a somewhat a common denominator for companies that are successful in doing this. And I'll go through all 7, but typically the successful companies they're working within a fragmented industry. An industry where there's a lot of opportunities, a lot of buying opportunities. You don't want to go into an industry where there's only, a small handful. The more supply of companies, obviously the better pricing power you'll have. So you need to see a fragmented industry. We find that typically successful M&A or successful roll-up strategies work well within industries that are boring. So companies, traditionally we've seen great roll-ups in things like the garbage pickup industry, the funeral home industry, automotive repair industry, things that tend to be I'd almost say your hands are dirty. They're a little bit more service oriented, but they're not exciting. They're not software. They're not, the newest artificial intelligence, things like that. You need to have a boring industry that allow for cheap pricing of businesses and not a lot of competition in startups and other other entities. So that's number 2. Number 3, it's great if you can capitalize on succession challenges. So you want to have a motivated seller where it might be someone who's interested in retiring and they don't necessarily have, family that can take over the business. Those tend to work really well because, again, you've got a captured audience, you've got basically a motivated seller, and sometimes, the successful entrepreneurs built up a business where he or she was able to generate enough income to send his kids to college, and maybe they become doctors, they become, lawyers or whatnot, and they really have no interest in running the family business. So you want that opportunity to be able to buy with these sort of succession challenges. So that's kind of number three. The fourth point we look for is someone who's very good at sort of creating financial strategies that work. So you want someone that understands how to manage cash and equity or debt in a transaction. You don't want to see somebody necessarily buying a business always with equity. You want to see some leverage. You want to have somebody that understands how that operates. A lot of times you'll be able to buy companies where the vendor wants to keep some component of equity. So you have to understand that. You also have sometimes there's what's called a vendor take back. So the vendor would be prepared to sort of technically loan the purchaser money so they can buy his own company. So you have to have somebody that understands those different variations and able to use that strategy. So that's number four. Number five, we like to see companies that are acquiring companies that there's value sort of day one. It's accretive the minute you buy it. So you're not buying it simply because there's going to be synergies down the road. You want to see some immediate accretive value day one. You want to see someone that's the acquirer that's constantly value driven. You don't want to be paying 8 times earnings when you can buy businesses at 4 or 5 times earnings. You want to find somebody who's constantly keeping strategically minded around value. And then sort of the last point is you want somebody who, a business that is able to operate and move quickly. The reason for that is, sometimes opportunities pop up very quickly. And a lot of times the best ones, there's some issue around it where you have to move quickly and you have to have that capability and mindset to move fast on an acquisition. So that's sort of the 7 that we typically find are the common denominator amongst companies that are successful in doing this roll-up strategy.
It's one of the points that I really wanted to follow up with you on is this idea that one of your keys to success that you saw is that you typically see this roll-up strategy work in these boring businesses, or industries, excuse me. And so boring industries. I'm gonna air quote that. It's not boring for everybody. It makes money, how can
not for me.
Yeah.
Not for me.
but why is it these industries really primed for this strategy, this roll-up strategy, M&A? What is it?
If you look at sort of a lot of the businesses you're seeing right now that tend to be overvalued or overpriced are things where there's a blue sky in the future. There's a potential for something to be dramatically different, dramatically changed, and hence the value can go up. And I think we see that with a lot of startups. We see that with a lot of sort of venture capital-backed businesses. A sort of tried and true business that's boring is something that isn't likely to have that massive blue sky, and the pricing is sort of sucked out of it. So, like I said, things like garbage collection industry or window repair industries or things like that, they're pretty static, right? They're going to grow a certain amount, and it's hard to place too much blue sky or too much blue sky value into these businesses. So you need a boring business that isn't creating a lot of competitive or new competition or new entries to compete with. But there's a high degree of static in their business and consistency that doesn't excite new entrepreneurs.
So it's really you're seeing some of these industries where there's just not a lot of new entrants, really. I mean, not necessarily boring industries, but where you're looking at an industry that doesn't have a lot of new entrants, where there could be some consolidation. Not because maybe the industry is shrinking, but even if it is growing, but just not as fast as some other sexier industries. I mean, is that have something to do with it?
Yeah, I think so. Yeah, I think it's supply and demand, right? If there's not a lot of new entries, if there's not a lot of excitement around an industry, it keeps participants out, and it makes it a more viable business in the long run.
My next follow-up to the 7 keys is when you when you're looking at the purchaser, the main person who's trying to roll up all these companies into one, how flexible are you when it comes to their discipline for making purchases? Are you pretty strict when it says, okay, if you say you're going to only look for businesses at that 4 to 5x multiple, then we expect you as an investor in your business to only look for that, but what happens if there's an opportunity that happens to be where the opportunity is at a 7x multiple to go and buy that business to bring it in? How do you evaluate that?
So discipline is key. Like when we see somebody stray a little bit too far from their disciplined approach, we start to get a little bit more worried. There's always the one-off, right? There's always the one company that might be a little bit more strategic fit, and you sort of accept that every now and then there's some deviance from that discipline. But more times than not, if they're starting to repeat and get out of that mold, it increases the risk and the danger. And a lot of times, the companies that we see that are successful early on in the roll-up strategy, where they start to fail is as the industry has kind of become a lot more consolidated, they're running out of opportunities, and they think that to feed the machine, they've got to go outside of that strategy, lose a little bit of discipline, and maybe reach. And that's when we start to see it really tail off and run into trouble. So discipline is a very, very key criteria. You don't want to see these acquirers start to deviate too much from that.
Got it. So my next question then too is, when it comes to M&A and this roll-up strategy, you always hear a lot of times where these companies will bring in a new business and then the culture war happens. And there's a big problem with, trying to merge the two cultures that these different companies basically had for however many years they had it. So, what do you look for there as an investor? Is it an evaluation of the original purchaser from the get-go, making sure that they have those core values that you align with to make sure that you feel confident that they'll be able to merge the two cultures? Or what is it? What are you looking for there?
I think there's two things to keep in mind. One is a change in culture through an M&A process is a killer. You want to make sure that you've got an acquirer that is good at implementing a standardized culture. You want to see success. The best sort of teller of success is seeing a company having done it a few times already. So the odds of the next one going sideways is a little bit less. But so culture becomes critical. You want to make sure that they've implemented changes that are not too sort of deviated from what the existing culture of the acquired company looks like. That's a critical piece. There's also the you also want to see a part of that I haven't discussed is that the acquired company, you want to see some vested interest in some of the people who are still sticking around. So, if it's management or if maybe the founder is still involved in the business, you want to see them still have a vested interest. And a lot of times that's done through a share position. It helps with the transition. You want to see deals structured so there is a vested interest to make sure that transition, whether it's culture or anything else, is handled well. So that's another thing I'd say to look out for is to make sure that the acquired company still has a vested interest in making sure that it's successfully integrated.
And Paul, one more question I also have for you today is, you focus specifically on Canadian microcaps. For this roll-up strategy, M&A kind of strategy. From what you've seen, is it different in the approach, let's say, in Canada versus the U.S.?
No, I think it lends itself almost anywhere geographically. I think the thing to watch for, though, is you want to see companies that don't stretch too far away from their sort of backyard. A company that's starting in Vancouver, you might necessarily want to see them, get their second operation in Florida. There is, you want to be close enough to see if there's anything wrong that management can sort of move on it pretty quickly. Also, you got to keep in mind too, there's different areas have different sort of maybe legal or jurisdictional issues around a certain product or service. So you just want to make sure that they're being consistent, they're learning to walk before they can run, and stick pretty close to their sort of backyard until it's time to move out.
Are these 7 keys for success, are they more as a guide to help an acquirer be successful in this type of business, or is this more of a guide for you as an investor to say, hey, this is how you can be successful investing in these types of businesses?
Well, I think probably both. We obviously we view it from an investor side, and we found that over time, the companies that continue to do sort of stick to these 7 criteria tend to just be better investments. Our job as investors is to really make sure that on a sure basis that the value that's created within this model is represented on a share basis, per share basis. So it's one thing to go and acquire and build a big business, but if you're constantly issuing shares to do it and, diluting it to the point where it doesn't increase shareholder value, that's the shareholder's problem, right? Management are probably still fine because they're, creating internal value and they might have bonuses or whatnot. But from an investor standpoint, you want to make sure that all is affected to creating share value on a per share basis. So, it's the more disciplined we are as investors to stick to that 7 criteria and recognizing the companies that are doing the same thing, I think the more successful we are as investors.
Paul, at the end of the article, you stated that, and I quote here, 70 to 90% of acquisitions fail to deliver shareholder value, end quote. And I quote, that's just for one deal, end quote. Yeah. Are roll-ups really worth the chase for investors?
Well, when you have some success doing it or investing in these companies, absolutely. I'd point to the fact that probably the most successful investment over the last 10 years, or the best performing stock over the last 10 years in Canada, is a company called Boyd Auto Body. And they're in the auto repair business. You're probably up about 60 times your money over the course of the last 10 years in a boring M&A style business. And they're a type of company that's followed all these 7 criteria. So, if you want to find companies like that and you want to do it without taking on a lot of risk, then I'd say, yeah, it's worth the effort. The ones that are doing it wrong and sort of that 70 and 90%, I think you can find them pretty quickly and stay away from them if you, again, follow the criteria that we've laid out here.
Okay. And just to quickly follow up there, are you currently a shareholder in Boyd Auto Body? No,
I wish I was, but I'm not.
So, another quick question I have to follow up on all this too as well is, I see a lot of microcap companies that say they're a mini Berkshire.
Mm-hmm.
They're the next, Warren Buffett type business. That's how they're running it. They're looking for companies like that where they're trying to stay diversified. For our investor audience out there, what would you say is the big difference between what you're talking about here in this article and, all these, microcap companies that are saying they're, the next Berkshire Hathaway?
Well, there's not too many next Berkshire Hathaways, that's for sure. No, I mean, part of the challenge is to find somebody who has been able to prove it that they can do it. So we don't get involved in a company that comes out and says that. We try to get involved in companies that are already doing it. And if you're finding the right roll-up strategy company, you've got a long runway. So you don't have to try to get in early. You can wait until you've seen clear signs of success. So, if it is going to be the next Berkshire or Boyd or any number of one of these companies that have done this, you've got a long runway to be able to validate that they're doing what they say they can. Yeah.
And for full disclosure, I am not a shareholder of Berkshire, Paul, just to make sure. Also shareholder, not?
Unfortunately, I'm not. No.
Cool. So, to kind of close up here, we also have a big event coming up in Vancouver, the Smallcap Discoveries Conference. You want to give my audience a little background on what they can expect to see there on October 17th?
Sure. So we've sort of hand selected what we think are 10 of the most interesting microcaps in Canada. A couple that actually fit that M&A strategy that we mentioned. But it's a great event. Lots of smart people, lots of great companies to look at, and with a little bit of luck, a little bit of good weather up here in Vancouver.
Well, luckily it's all going to be inside, so
It is.
so we don't have to worry about that.
True.
So just to close up here, where can my audience now go and find more information about you and Smallcap Discoveries?
Smallcapdiscoveries.com, all one word. That's our website. They can email me at paul@smallcapdiscoveries.com, and happy to answer any questions anybody might have about the Canadian microcap space.
Paul, thank you again for joining me today. I really do appreciate it.
Anytime, Bobby. Thanks a lot.
Thank you.